In this presentation, we will take a look at liquidity and efficiency ratios. Our information is going to be on the left-hand side. We're going to enter that information into the blue areas to record our liquidity and efficiency ratios. Using that data, we do recommend setting up your Excel worksheets in this format to have the information either up top or to the left, the words in a separate cell as the numbers so that you can refer to the numbers with cell references. That's going to be the most efficient way to move forward. What we have is our balance sheet. We've got the balance sheet for A and B. We're going to say that these are going to be two separate companies, so we can basically look at two sets of numbers as we go through these ratios and do some comparison as we go through them. And then we have the income statement as well. And then we're going to have some prior year data, which is going to be necessary for some of the ratios that we will be considering. So first, we're going to go to some of the most common types of ratios. So when we think about types of financial ratios, some of the liquidity ratios are some of the most common. So you're going to want to know these well, especially the current ratio, probably the most common ratio and the most useful type of ratio. And then we're going to have the acid test ratio, or the quick ratio, sometimes called, which is also a very common type ratio. So let's start there. We're going to say that the current ratio is simply going to be the current assets divided by the current liabilities. Current assets over current liabilities. We're going to put this in place in more of a kind of a vertical type of format in Excel. I think this is really helpful to do because this lists out how you'll actually enter this data into a calculator. The current assets, we're going to have our information on the left. It's going to be on the balance sheet. We didn't break out, this balance sheet doesn't break out the current and long-term assets, as you'll often see in many balance sheets, and that allows us to take this data and say, okay, which of these assets are current and which are not. So if we go down here, cash is current, receivables are current, merchandise inventory current, prepaid expenses current, plant assets not, because that could be plant asset, property, plant, and equipment. It could be called depreciable assets. Those are going to be the long-term assets. Therefore, we'll use the sum function here equals the sum of, and we'll sum up the 19,000 down to the 5,100, not including the 370. And then on the liabilities, we want the current liabilities. That includes the, what we haven't just grouped here as current liabilities as opposed to the long-term liabilities. So we're just going to say this is equal to the current liabilities. And then we can do our ratio, which is going to be the current ratio dividing this out. It is a ratio. It's going to be equal to the 142,740 divided by the 61,340, and that's going to give us our 2.3. Then we're going to compare that to B over here, and we're going to do the same type of calculation. We could autofill this over if we autofilled it, but we're going to calculate it again so that we can see it with a different set of data. So once again, we're going to have the cash, accounts receivable, merchandise, and the prepaid expenses, not including the plant assets. Let's do that with a sum function equals the sum in G4. And then we're going to select the 35,000, the 52,400, the 145,000, and the 7,750. That's going to give us the 235,650. Then we'll pick up the current liabilities, which is going to be equal to the 100,300. And then we can do our ratio, which is equal to the 235,650 divided by the 100,300. And that too gives us the 2.3. So you can see that we have drastically different numbers here in terms of dollar amounts, but the ratio, the comparison between the two, is in essence the same to one decimal, the 2.3, 2.3. Now note, some of these won't be even. If we add decimals, just be aware of that all the time. You're always going to have to be thinking, what is this problem doing? What decimal point is it asking me to go to within the problem? You're always going to have to consider that as you go through these. Then we're going to go to the acid test ratio. Now, if you consider this ratio, note what we're thinking here. How many times over can we pay off the liabilities with the current assets in essence? So 2.3 times we can pay off the liabilities. Here, although we have a lot more assets, we also have a lot more liabilities, and we're still at the 2.3 times of being able to pay off the liabilities with the current assets, pay off the current liabilities with the current assets. Now let's go to the acid test ratio, which is a bit more stringent, because what we're going to do is change the numerator, but not the denominator. Denominator stays the same, current liabilities. Numerator, more stringent, not including all of the assets that were included in the current assets. So we're going to have the top number called quick assets, oftentimes, and those are going to include the 19,000 cash, the accounts receivable, not the merchandise inventory. So that's in essence where we stop here. That's generally where you stop. The merchandise isn't included. Typically, that's where you stop on this. So we're going to say, all right, this is equal to the sum of the cash and the accounts receivable, not the merchandise inventory. And then the current liabilities, I'm just going to say that that is the same as the data up top, or we can pick that up from there or here. And there we have that. And then we're going to say that's going to give us our acid test ratio, which will be equal to the 53,400 divided by the 61,340. And then enter. Okay, so obviously this number is always going to be less than this number because we're going to have a reduced numerator and the denominator stays the same. Let's do that for B now. B equals the sum on the current assets. We're going to sum up the cash, 35,000, and the 52,400, the accounts receivable, and that's it. And then on the liabilities side, we're going to say that this is equal to the current liabilities, 100,300. Then we'll divide these two out. We're going to say this is equal to the 87,400 quick assets divided by the current liabilities, 100,300. That's going to be the 0.9. And again, drastically different numbers here, but the ratio between the two, much the same. How many times can we pay off the liabilities, current liabilities, with the quick, more stringent type of assets? Next, we're going to go to the inventory turnover. So the inventory turnover calculation, this usually being one that's a little bit more complicated, a little bit longer for people to basically grasp and get their mind around, partially because we will be having both balance sheet accounts and income statement accounts in the ratio. Whenever you see inventory in some type of ratio analysis, you're probably thinking the other side is going to be the income statement account related to inventory, which is going to be cost of goods sold. So we're often comparing, you're thinking the two numbers are going to be, all right, we're dealing with inventory, it's an asset type account. The other one's going to be cost of goods sold. When we deal with an asset type of account like inventory, then we often think, well, is it going to be average inventory? We might have to do with this average thing. And that typically means we'll have the beginning balance and the ending balance. So note, if you see this in a formula, it's just going to say cost of goods sold divided by average inventory. But then we're going to have to figure out what average inventory is. So you want to be able to think about this in your head and think about how you're going to set this up in a problem, because just knowing the ratio isn't typically enough, because we need to know the components of the ratio, in this case, the average inventory calculation. So I recommend this longer kind of format of calculating this out. This is how you would actually have to put it into the calculator. So we're going to say that it's going to start with cost of goods sold. And if you visualize this type of calculation, you'll be able to do this by hand. You're just visualizing the table, practicing it enough so that you can visualize what you're trying to write. And if you have to do it more slowly by hand, that's fine. You'll do it more efficiently if you know the table, the format that you're going into. So I'm going to say the cost of goods sold, we're going to put that in an outer column here. So we're going to say that cost of goods sold is in the outer column. We're going to pick up the 592,100 on the income statement. Remember what that is, of course, the cost of goods sold representing the inventory that we sold, cost of the inventory that we sold, which is an expense type item. Then we're going to calculate the average inventory. And I'm going to pull this into the inner column as a sub-calculation. So sub-calculation, we're going to start with the beginning inventory, then add the ending inventory, then divide by 2. Whenever we see a balance sheet account, you want to think that that's probably the type of calculation you're going to have when you see an average on a balance sheet account. Why? Because we're trying to figure out what the balance is at any point, any given point in time. Although the balance sheet account is a point in time type of account. So just be aware of that. We're trying to average out, although the balance sheet is basically a point in time, what the average point in time would be given the entire time range or period. So we're going to say, all right, the beginning amount isn't on our financial statements because these show the ending amount. Where do I get the beginning amount? From the prior year's financial statements, because those are the ending of the prior year and therefore the beginning of the current year. So I'm going to say in our data, it's going to be in this other information from the prior financial statements. We're going to be picking up the beginning merchandise inventory, the 57,600. And then we want the ending inventory. So next we have the ending inventory here, and that's going to be equal to, we're looking for the ending inventory on the balance sheet. So here's our merchandise inventory. It's going to be the 84,240. So the 84,240. Then we will add those up. So we're going to add those two up. And that's going to be the sum equals the sum of these two items. And that's going to be the 141,840. Then we're going to divide by 2. So we'll divide by 2 to get the average. I'm going to pull this out to the outer column now, because this is going to be the average inventory. So the average inventory, then it's going to be equal to the beginning and ending added up divided by the two of them. That gives us the average for the period, what we think it would be at any given kind of time. So then I'm going to pick up the actual calculation. The only thing that we would actually see in the formula probably being equals the cost of goods sold, the expense item, divided by the average inventory. And that gives us the 8.2. Let's do the same thing for B over here. So B, I'm going to start with the outer column. I'm going to pick up the cost of goods sold. This is going to be equal to, if we scroll up, we're going to scroll down. We want the cost of goods sold, the 652,500. Then we want the beginning inventory. That's going to be in the prior year's financial statements, or in our case, in the other data down below. So the beginning inventory is the 109,400. Then we want the ending inventory, which is on our current financial statements, because the current financial statements are as of the end of the time period. That's going to be the 140,500. We're going to sum those up or add those up. That's going to give us the 249,900. Then we'll simply divide by 2 to get the average. Actually, I put the 2 over here. Divide by 2. And then we'll say this is equal to the 249,900 divided by 2. And that's going to give us the 124,950. And then we'll divide this out. This equals the cost of goods sold in the outer column, the 652,500 divided by the average inventory, 124,950, giving us the 5.2. So this is showing us how many times on average the company has sold and basically replaced the inventory. So it's been sold and replaced more for A than for B. Next, we'll take a look at the days sales in inventory type calculation. This is going to be a similar type of calculation, also dealing with inventory, and now you're considering the other account, which is going to be cost of goods sold, typically what we're going to be comparing the inventory with. So we're going to have the merchandise inventory. That's going to be our starting point. We'll pick up the merchandise inventory. We're going to pick up the ending balance this time rather than the average as we saw last time. That's going to be on the balance sheet. This is as of the end of the time period, 84,240. And then we're going to pick up the cost of goods sold number. So we're looking for the cost of goods sold. That's on the income statement. So we're going to say that this is equal to. We're going to look at the income statement. We'll pick that up in B18. That's going to be the 592,100. And then we'll take a subtotal dividing those two out. So this is going to be equal to the 84,240 over the cost of goods sold, 592,100. That's going to be the 0.14. And then we'll take the days in a year, which are the 365. And that's the days sale in inventory number, which will be equal to the 0.14 times the 365, or the 51.9. Let's do the same thing for B here. We're going to say the merchandise inventory at the end of the time period. Ending merchandise inventory is going to be equal to the balance sheet item for B, 140,500. We're then looking for the cost of goods sold equal to the 652,500 on the income statement. Then we'll divide those two out. This is equal to the 140,500 divided by the 652,500, and that gives us the 0.22. We'll then divide that by the 365, the number of days in year, which is going to be the 0.22 times the 365 days, giving us the 78.6. So the average days, the days in inventory necessary to convert the inventory to sales, is 51.9 for A and 78.6 for B. So that would typically be better, you would think, for A with that conversion. And that, of course, lines up with our ratio up here, the inventory turnover turning over quicker for A than B. So next we're going to do the days sales uncollected. This ratio is going to start off with the current receivables and comparing that to the net sales. So we're going to say the current receivables, current receivables are going to be equal to, so we're talking accounts receivable here, equal to, and we'll scroll up to the balance sheet because we're looking for a balance sheet account at the 34,400. Then we want the net sales, not net income, net sales. We're not talking about the bottom line, we're talking about the net sales after if we had an extended income statement after the returns and allowances if we had returns and allowances. And so we're going to scroll back up and say that we want the net sales, and we're just picking up the sales line, the 780,000. Again, not net income. We're not picking up the bottom line. And that's going to be the 780. Then we're going to have the subtotal. So we'll pick up the subtotal, and this is going to be equal to the 34,400 divided by the 780. I'm going to call that a subtotal. So we're going to say that's a subtotal. And then we're going to have the days in a year. Multiply that times the days in a year, 365. And that's going to give us the days uncollected. Days uncollected then will be equal to the 0.04 times the 365, giving the 16.1 days sales uncollected. So we're obviously looking at how long it's basically going to be taking for have the sales from the point of time that we're going to basically receive payment on those sales, the collection on those sales. For B then, we're going to say this is going to be equal to the receivables. So we're going to scroll up top and take a look at the receivables, which is the 52,400. And then we'll take a look at the net sales, the top line, not the bottom line, not the net income, but the sales. And that's going to be on the income statement. We're picking up the 898,200. And then we'll divide those out for the subtotal. This is equal to the 52,400 divided by the 898,200. That's the 0.06. Then the 365 days in a year equals then the 0.06 times the 365, or the 21.3. It looks like A is performing better here as well because it looks like it's taking less days on average to collect the accounts receivable as with B, 16 to the 21.3. Next, we'll take a look at the total asset turnover calculation. So the total asset turnover is going to be another one of those calculations that uses an average type of method. So for the total assets, we're comparing the sales or net sales, not net income, net sales, to the average total assets, which in that case, we're going to be taking the beginning and ending, dividing by 2, because we're talking about a balance sheet item with the total assets. So we're going to start off with the net sales. So we're going to say net sales, and I'm going to put this in the outer column this time. This is one of those calculations we want to visualize, maybe get down in terms of how we're going to format this thing, because once again, just having the formula can be a little bit confusing because it's going to be divided by this average, and then you're going to have to break out the average. So we're going to say, I'm going to put this in the outer column, and we're going to say this is going to be equal to, we'll scroll up to the sales, the 780,000. Then we want the average total assets. So we got the average total assets, which will have the beginning assets. So we're going to start with the beginning assets here. Now, where do the beginning assets happen? They're not going to be on the current balance sheet. They're going to be in the prior year's ending balance, right? Because the balance sheet of the last year is as of the end of the last year. And that's what we want for the beginning of this year. So we're going to be picking up equal to the prior year total assets, which is the 388. So the 388. And then the ending balance is going to be the current year's total assets. So we're going to say the ending balance is going to be here. We're going to pick that up and say equals, and we're looking for the ending balance on the balance sheet, scrolling up, and we'll pick up the total assets here. The assets, there's the total assets, the 512,740. And then if we sum those up, that's going to give us a subtotal. So I'm going to call that a subtotal here, equals the sum of these two items. That's the 900,740. And then we're going to divide by 2. So we'll take that and we'll divide by 2. And that's going to give us our balance of the average total assets. So we're going to say this, and I'm going to pull that to the outer column now. This is going to be equal to the 900,740 divided by the 2 to give us the 450,370. Then we can calculate the total asset turnover now that we have our two components. So once again, if you see this formula, it's only going to have net sales over the average total assets. And then you're going to have to basically break this out. So you want to format that or think about that or feel how you're going to basically process then this information. And you might want to think of a table like this although it's longer than just the calculation that they show in the ratio. It's what you're actually going to have to do. So we're going to say this is going to be the 780,000 divided by the 450,370, or net sales divided by the average total assets. That's going to give us the 1.7. Then we'll do this for B. So I'm going to go to the outer column for B. We're picking up net sales, which will be equal to, scrolling up, we're looking for the net sales, which is 898,200. And then we want to bring in the assets. So we want to bring in the beginning, which is not going to be on the current balance sheet, but we need the assets from the prior year ending balance, or the prior year balance sheet, which is the ending balance. So that's going to be in our prior year data. Here's the total assets. We have the 402,500. And then we're going to pick up the ending balance, which is on the current balance sheet. This is equal to, we'll scroll back up to the current balance sheet, and we want assets, total assets, and we're going to pick up the 540,050, and then we'll sum these two up. This equals the sum of the 402,500, the 540 and 50. That's the 942,550. Then we'll divide that by 2, and that'll give us our average total assets, which will be equal to the 942,550 divided by 2, or the 471,275. Now we have our net sales, we have our average total assets. We can then divide them out, which is equal to the 898,200 divided by the 471,275, or the 1.9. This ratio is measuring how efficiently we're using our assets. So we got our net sales. This is going to be what we're earning on with our revenue, our top line on the income statement, divided by the fixed assets, the things that we're using on the balance sheet in order to generate it. And therefore, we're saying that we're getting a 1.7 return for A and a 1.9 for B. So B is looking better in this case.